8% yield. Global diversification. Sounds like the perfect passive income ETF. So, why has this ETF only returned 6% since launch? Welcome back everyone, I'm the Swedish dividend investor. So, we're going to take a look at SDIV or UDIV, Global X SuperDividend Ucits ETF. We will go through what the ETF is all about, holdings, sectors and country allocation, performance, dividend history, and we will do a valuation. As always, this is not financial advice. I'm just sharing my own investment journey, my experiences and my analysis. Read the full disclaimer in the description. The Global X SuperDividend Ucits ETF seeks to track the sole active Global SuperDividend Index. The index tracks stocks with high dividend yields from around the world. Global X SuperDividend is often known as a dividend trap. However, they have changed their strategy, but that was already implemented when they launched their ETF as a Ucits version. It was a rabbit hole I won't go into in this video. Basically, they changed from the sole active Global SuperDividend Index version 1 to version 2, where they focus on a bit more higher quality rather than just the highest dividend yield. Dividend over 6% and below 20% on the selection day for companies who are no index components, and dividend yield above 3% for which are currently index components. At least $500 million market cap on the day of selection. Average daily trading value of $1 million over a 3-month period. Dividend forecast is at least stabled, i.e. there is no official announcement that dividend payments will be cancelled or significantly reduced in the future. No closed-end funds. Business development companies. Partnership. Both qualified publicly traded and non-qualified partnerships or trusts. The companies are ranked in descending order according to their dividend yield. They also write how they view dividend cuts and adjust accordingly. Index components which have a quarterly reduction of the dividend payment under 20% are selected, and over 20% are part of the review pool. And they basically include the highest ranking company in the index until the index consists of 100 companies. So yeah, a bit complicated, but I think you get the point. Let's go over some stats for the ETF. The fund size is 759 million euros and the total expense ratio is 0.45%. And the fund is domiciled in Ireland. Checking their top 10 holdings of 101 holdings on their website, we can see Thai Foods Group, Ithaca Energy, Vårenergi, Bradsaude, Petroleo Brasileiro, Intelbras, Nordic American Tankers, Harbour Energy, DNO and Flex LNG. So a very energy heavy top, probably because of the run-up in energy. Sector allocation, biggest to smallest. Financials, energy, real estate, industrials, consumer discretionary, communication services, materials, consumer staples, technology, healthcare, and utilities. Country allocation, US, Brazil, UK, Norway, Hong Kong, Bermuda, Indonesia, South Africa, Thailand, Spain, Kuwait, and other. I would say that's a bit different from what we usually see in something like a global ETF. So let's check their performance. If we just look at their 3-year return, it doesn't look bad at all, about a 50% return. However, changing to the max time frame, it paints a different picture. So let's do a comparison of UDIV, S&P 500, VDIV, and let's go with SMLD or MLPD, another high-yielding ETF. It is, however, only energy focused. Year to date, MLPD at 17.30%, no shocker here. UDIV at 11.90%, VDIV at 8.63%, and S&P at 8.13%. 1 year, UDIV at 31.87%, VDIV at 27.17%, S&P at 26.51%, and MLPD at 13.86%. So we actually have something that beats VDIV. Impressive short-term performance. Max time frame 17th of February 2022. MLPD at 94.06%, VDIV at 86.51%, S&P at 67.77%, and UDIV at 6.46%. Well, here we can see the massive lag of UDIV. Let's have a look at UDIV's dividends. I'm a small creator on YouTube. Hitting the like, commenting and subscribing helps the channel massively. Thanks. So, based on last year's dividend of $0.92, that's 0.78 euros, that's a yield of 8.62% today. Their distributions are paid monthly. If we look at their history so far, we do see a massive decline from the highest year of 2023. But looking at their dividend until May of 2026 versus 2025, we actually see a small increase. Could this be the year where the trend changes? Who knows? We won't do a dividend projection since the dividend so far has been on a decline, and the only metric we have is the growth from the first ever dividend, a compound annual growth rate of 6.58%, which is way too high to project for this ETF. So let's do a valuation. Why do we do a valuation? So we don't overpay for an investment. We want to be able to somewhat guesstimate what kind of returns we could get over a 10-year period. We use a growth rate to project the dividend growth 10 years forward. A terminal multiple, this is what kind of yield investors give the investment 10 years forward. A high multiple means a low yield, so a higher price, and vice versa. We also use a discount rate. This is our required return, and it is used to discount the summed value back to today, and we get a present value. The present value is what we would need to pay to meet our required return. If the asset is trading above the present value, it is overvalued, and the other way around. We use 3 scenarios: normal, best and worst case. Finally, we will do a mixed valuation to get a fair price between all the scenarios. I've gone with a discount rate of 10% for all cases. Starting off with the normal case, I've gone with a growth of 0%. No growth. This ETF hasn't proved that it can grow its dividend. A terminal multiple of 12. So investors value it at a yield of 8.33% 10 years in the future. We land at a present value of 8.41 euros. For the best case, I've also gone with 0 growth, but with a slightly higher multiple of 14. So investors give it a yield of 7.14% 10 years in the future. We land at a present value of 9.01 euros. For the worst case, I've gone with something that's more like its history, negative 2% for 10 years. A terminal multiple of 10, so investors give it a yield of 10% 10 years out. We land at a present value of 6.88 euros. Let's wrap it up with the mixed valuation. I've gone with a probability of 60% for normal case and 20% each for best and worst case. We land at a fair value of 8.22 euros or 7.4 euros with a 10% margin of safety. Changing the discount rate to 8.5% for the normal case gives us a present value in line with today's price, meaning if we were to buy today and get 0 growth and 0 decline of the dividend, we could be looking at an 8.5% annual return. So what's my conclusion? Checking seekingalpha.com, we can see they have stabilized their share price since the index change of 2022, which were a down year. But I would say it has more to prove to gain investors' trust. The yield is high and I do like the monthly income. It is somewhat stable. But as I said before, I want to see proof the newer strategy is working. I would say, if you would want to buy this, buy it at a massive dip when you can get a 10% yield and just hold it. I would definitely be very cautious buying at these levels. Sure, if the strategy plays out and you dollar cost average, it could be a great play, but I'm not convinced yet. I want to know what you think about this one. Is it a dividend trap or a hidden gem? Do you hold it? Let me know in the comments. Thanks for watching. I will see you guys in the next one. Until then, stay smart, stay patient, and keep stacking those dividends. Ha det gött!